Boom. Right. So firstly, I think for the past couple of sessions, we were covering the ebook, and obviously there's a section in the ebook which we got to, which details a bit more in terms of market structure, right? Just candlestick patterns, and I thought it would be better if we just go into the charts instead of using the ebook for that. However, if you do want to go through the ebook, you can do so. So sort of like as additional sort of knowledge that you can go through, but it's more or less the same thing. And I detail, obviously, in writing there the decision making that actually goes behind each and every single trade, and just viewing the markets in terms of structure and being able to dissect the markets. Because, like I always say, it's better to understand the market dynamics than to understand candlestick patterns, because candlestick patterns can change. Candlestick patterns can change, but the market psychology will remain the same. Right? It's all about where the money is and where the money is going. So if you can figure those two out, then you'll be able to consistently draw some profits from the market. So, I was actually making noise earlier today because I had an issue with the broker, so I wasn't able to actually trade today because they disabled some instruments on the account, so I had to actually get that sorted. So I missed out on some action, but I hope you guys actually made some money today. Hope you guys made some money because the markets were really good today. And yeah, the setups lined up in terms of what we use with a 5-star strategy. So if you want any hints on what markets to look at that actually played out the way that I detail in the ebook, you can just look at Australian dollar JPY, NZD JPY, Australian dollar, US dollar, which other markets? I think you had your Euro JPY as well, okay, your USD CAD also, as well as your Euro AUD. So you had a lot of opportunities to actually, make some money off of some of these markets, and the markets have been pretty quiet. So the markets were quiet for quite a period of time, and then after that, I mean, obviously we should expect a bit of an explosion, and seeing the markets move like this is kind of exciting. However, that's not the issue today, and dealing with market structure, right? So the market structure is basically how the market looks like, right? So it's just like how any other structure would be, like that you would see on a day-to-day basis. The market structure is sort of like built from price, right? So it's built from price. So it's just representative of what the price is. So since it just represents what the price is, okay, it's critically more important for you to understand how the markets move in terms of behind the scenes, the market dynamics, as opposed to just being able to read chart patterns, head and shoulder, I don't know, cup and handle, whatever the others are. So the markets have a series of movements, right? The markets will typically do one of two things, right? The market will go up and then they'll go down, right? And then there'll be a bit of a sideways consolidation, right? So it might move up, it might move down, it might move sideways, but that's about the only movement that you can expect from the market. There aren't 100 or a million or 10 million different outcomes in terms of what the market could do. It's either going to go up, or it's going to go down, or it's just really just going to range sideways. So understanding this, you need to understand then the structure, right? The structure of the market is that there'll be a few candles that go up, and then there'll be a few candles that go down. So some candles will go up, right? Well, this is down, okay? And then the market will pull up, right? Now, typically I use the old adage, which says the markets will move 2 steps forward and one step backwards. So typically in a trending market, you'll have the market move down 100 pips and then pull up, let's say 50 to 60 or 80 pips sometimes, and then push down again and then pull up. Right now, this is typically because obviously there's a lot of profit taking at certain areas in the market. So profit taking from the major players in the market will obviously result in the market sort of like moving towards upside. So if it's been pushing towards the downside, big players have been sort of like selling the market, selling the market, selling the market. And then once they cash in their profits, that basically means they're buying back whatever they were selling. So their position, they're buying back at a much cheaper price. Hence, the market will go up again, right? And then obviously they might go in and start selling again, and then cash in terms of taking profit, and the market will go to the upside, right? So now I know I make it seem very simple and easy for you to understand, but that's really what it is when it comes to the market. The whole trying to figure out where it's going to go after this and that. Me, I'm not concerned about whatever time frame that I'm actually looking at. So if I'm looking at a day trade, I'm only concerned about what the market basically does today. If I'm looking at a swing trade, I'm only concerned about what the market will be doing for the rest of the week. Okay. And obviously, if I'm doing a position trade, which is a long-term trade, then I'm concerned about what the market will be doing in the next couple of months. Okay. So first thing you need to figure out is that, right? So what is your main time frame? And what is your objective, right? So your approach, if it is short term, you'll be using smaller time frames. If it is, let's say, swing trade, then you'll be using, let's say, your 4 hour, your 1 hour, and your daily. But if it's long term, you're going to be using your monthly chart as well as your weekly chart. Okay, because you can go to the weekly, you can go to the monthly. More or less, what you're going to get is the same. The markets have a period of going down, right? And then they'll pull up, and then they'll go down again, and then they'll pull up, and then they'll go down again. That just represents profit taking from the large institutions. So two things would actually happen at these points, right? So if we're looking at the market pulling up here, right? Basically, two things will essentially happen, right? So when the market pulls up, boom, okay, this will usually stop out some of the guys who are actually chasing the market going down. Because if you've ever traded live or even traded demo account, it's very the market sort of like suck you in to a position that you're not supposed to be in. So you plan that you're not going to trade the Euro CAD anymore, but you start seeing this, right? And you're like, okay, the market is dropping like a rock. Now it's time for me to actually enter that position, and you see the market pull up a couple of pips, and let's say this is where exactly where your stop was, trigger your stop loss, and then move back towards the downside. And the market does this repeatedly because all the market is basically psychology, right? Understanding what the other market participants or players are doing at a particular time, right? That will help you to forecast where the market is going, although technical analysis is only part of your success in trading, but it is a critical part in any case. Okay. So the structure then develops from that. So pullbacks towards the upside, okay, that's why we use the Fibonacci retracement tool. We can actually measure the percentage pullbacks to see, okay, what percentage did the market pull back into. So we'll cover probably the Fibonacci tool towards the end of the month. Okay, no, not really. Probably 2 weeks from now, because obviously this is more of a beginner session, but we've covered it like numerous times in the advanced session. So if you need that, just go through to the YouTube channel. You'll find a ton of videos on the Fibonacci retracement tool. So let's say we see the drop, right? Market pulls up, and now we actually have a retracement, right? This is what we call a retracement. So this would be a retracement. So if the trend is down, the retracements are actually going to go up, and the market will continue going downwards, and then the retracements will go up, and then the some call the impulse move. Okay, some call it an impulse move. I think people who trade Elliott wave typically use that, but for me, I just call it the momentum. Right? So I just call it the trend move. You can call it whatever you want, as long as you understand that that is the move that you particularly want to be involved in. Right? You don't want to be involved in the retracements, okay, which is the pullbacks going against the trend, because you don't really get a lot of bang for your buck when you're trading those markets. Right. However, if you're trading markets which are trending downwards, you want to be a short seller most of the time. You want to go short most of the time and not trade against where the trend is going. Okay. All right. So the market structure then develops in this sense. All right. So sometimes you might see the market break or create a support level and then break it, then come back into that level again, which is now resistance. Okay, retracement, repeat please in relation to breakout. Okay, no, I was basically saying when it comes to the retracement, right? So retracements will always be there in the markets, right? So what we want to do, particularly we want to be able to identify where the retracements are going to come in, right? And then enter the market in the direction of the trade. Right, so if the trend is down, we'll be looking for, let's just say, a support level. Okay, a typical support level will be an area where the market has previously rejected. Okay, so an area where the market has previously rejected, sort of like this, and move to the upside, because this is a downtrend, but now the market made a swing low at this point over here. So at 56.15, the market made a swing low, moved away from that low, and then came back down and broke 56.15. And then the market retraced back into 56.15 and then pulled towards the downside. So that is basically a trend line, that is a support level being broken, and then it becomes resistance. And it is resistance because the market moved back. It retraced back into that area, which was previously a very strong buy area. Remember, if price is going up, then it means that it's a strong buy. And then if the price is going down, it means there's some strong sellers in there. Okay. So that's all it is when it comes to the retracements. I mean, like I said, once we get into the Fibonacci and all of that, we'll be able to measure the percentage pullbacks and apply which area sort of like provides us with a high probability area. Okay, so high probability of the trade working out would basically mean out of 10 times you win 8 of your trades on average. Okay, a low probability setup would be you win 2 out of 10 of those trades. Okay, so there's not a lot of the probabilities of the trade working out. The 2 out of 10 are very low, right? So very high ones would have certain levels, right? So you'll trade certain levels in terms of percentages of the pullback, because can't trade each and every single level. If we try and trade each and every single level, we'll be in the markets consistently. You just want to isolate one particular level of the Fibonacci, focus on that. When the market gets inside that level and we have all our other triggers sort of like lined up, then we take the trade. I mean, aside from that, we're not trading anything outside that range. Okay, guys, this makes sense. Okay, right. So now when we're talking market structure, we're basically talking this. I mean, the market will then range, right? Now range will look something like this, all right? So let's just get to some ranging market over here. Okay, let me just get to some ranging area in the market. Okay, there is a range. You can see that the market has been moving sideways. There is no clear directional bias, and it's very easy to spot that it's a range, aside from the fact that it's not making swing highs and swing lows, right? Aside from the fact that it's not making swing highs, higher highs, and then breaking them, and then not breaking the lower lows. It's just pulling back. Okay, let me just fix this. Thing is, I don't like having this background. Yeah, there we go. So it's just pulling back as soon as it touches a resistance, pulls back as soon as it touches support. Now this was a couple of weeks, might you imagine? And also one of the telling signs is just the moving average. When you're looking at the moving average, it's in the price, right? So it's right within the price. Typically when the market is trending, the moving average will be below the price. So when it's trending up, the moving average will be below. And when it's moving sideways or ranging, it's sort of like going to be in between a range. So you won't be able to tell with any sense of certainty which direction the trend is in. So when you start getting confused about which direction the trend is in, probably just take a step back, either go into the higher time frames or just zoom out, and then you'll probably see that the market is probably ranging, and you should stay away for a while from that particular market and sort of like trade other markets until it, I don't know, sorts its issues out. So that is, I believe, the main thing and the most important thing you can do, because there is an approach that you can use to trade a sideways ranging market. Okay, so when the market starts moving sideways like this, there's a strategy that you can apply that will work in a sideways ranging market, but you need to be able to note what the difference between the two is. Okay, for me it's very easy because I don't like complicating things. But a lot of other people have to complicate things. They'll make a decision and they'll change that decision and then they'll go back to the initial decision. So it's just a lot of admin work, which means that the trade that they finally do take is not one that they have a lot of confidence in, right? And with trading, confidence is everything. Okay. All right. So understanding then how the dynamics of the market work. All right. So where the larger players are coming in and where the larger players are typically getting out, we can then be able to make much more informed decision about where our entries are going to be. Right. Not only our entries, but where least likely our stop losses will be triggered. So we can actually plot just using the market structure. Right. Just by being able to look at the candlesticks and see where the swing highs are, the swing lows are, and which direction generally the market is going. And then let's say throw in the Fibonacci, we can make a much more informed decision about whether we are buying that particular market or we are selling or we're just staying out. Okay. So that's also part of a trading decision that you actually make on a day-to-day basis. Deciding not to trade a certain market is also a trading decision. Okay. All right, guys. Any questions? Any questions? Any questions? Okay. If you have questions, just either type the question or you can just click on raise your hand. All right. So in the meantime, I sent a link in the Telegram channel regarding the competition. Okay, so I sent a link regarding the competition. I will be uploading the rules to the competition a bit later on. So I'll do that separately. But the competition basically is, like I said, it's not going to be just a measure of how much money you can make. It's going to be just in terms of performance wise, balance. What sort of balance do you have? Because it's easy to make 100% of your account per week, risking 100% of your account per day. It's easy to make 50% of your account per day if you're risking 100% of your account each and every single day. So bigger risk for smaller returns is not one of the wisest things that you can do in your trading. So you want to have your bets a bit bigger. So on average, if you're winning, your trades will pay out, let's say, $200 or $300. But when you lose, you only lose $50 or $100. Okay, so if you can structure things like that, and then obviously you need to have a really good win ratio where majority of your trades actually make money. If you can do those two, then you're on the path. You don't even have to win majority or most of your trades in order to make money trading. That's the weird thing. A lot of people don't seem to understand that even with a 40% win ratio, as long as your wins are much bigger than your losses, then you will be net positive. You'll be making way more money than the guy with a 99% win rate, because that 1% when he loses the entire account. Okay. All right. So if there are no other questions, like I said, I'll send through the details regarding the competition. $100 first prize, second prize $300, and third prize is $200. Unfortunately, fourth will because at one stage I was like, okay, let me just give the $1,000 to one person, but then my partner and I sort of like had a discussion regarding this. So it's going to be 3 participants, and you'll be able to join from now up until Monday. Doesn't really matter the account size. Doesn't really matter the account size or the lot size you use, just as long as you're keeping to the money management rules. Okay, it should work out. Okay. All right, guys. So I will be sending the recording in the Telegram channel. So if you missed any parts of this,